The topic of this series, as it has been widely circulated, is market value, fair value, a comparative analysis for proper assessment of value. And the resource person that we do justice to the topic this morning is our erudite professor of valuation from the University of First Choice and the pride of the nation, the University of Lagos. Is no other person than Professor G.K. Babawale. We are also going to be having in the panel room, we're going to be having in the panel room the sponsor of this webinar. Here's the Estate Surveyor and Valuer Victor Adekunle Alunge. Also in the panel room, we'll be having the Estate Surveyor and Valuer Adetola Shote, the 6th President of Nigerian Institution of Estate Surveyors and Valuers. In the panel room, we also have the Regulator General, or the Chief Regulator, Estate Surveyor and Valuer Gashom Enshaw, the Chairman of SVABO. We are going to be bringing them into the panel room as they join. In the panel room also, we'll be having the 23rd President of Nigerian Institution of Estate Surveyors and Valuers, Estate Surveyor and Valuer Rula Dabonta. We're also going to be having in the panel room Estate Surveyor and Valuer Emmanuel Okas Wike, the 24th President of Nigerian Institution of Estate Surveyors and Valuers. In the panel room also, we have Estate Surveyor and Valuer Dr. Samson Agbato, the principal partner of Samson Agbato Consulting and one of the directors at Risk Academy. In the panel room also, we have Estate Surveyor and Valuer Olalika Boderi, the lead advisor of Olalika Boderi Consulting and the director of studies of Risk Academy. Now, in moving forward, I want to quickly call on Estate Surveyor and Valuer Samson Agbato to give a brief background of this webinar series. Estate Surveyor and Valuer Samson Agbato, please.
Good morning, distinguished noble colleagues. Our past presidents in attendance, the president of the Nigerian Institution of Estate Surveyors and Valuers, the first and second vice presidents, and other protocols duly observed. Thank you, Mr. Kamal, for the privilege you have given to me. I want to mention that Risk Academy is a training institute established to build capacity and competencies of our members. And in doing that, we have been having relationship interactions with our colleagues in sponsoring some specific topics. And one of them is our first Vice President, ESV Kunle Alunge. For this particular series, we have a team that is titled Fundamental Knowledge of Property Valuation for Best Practice. We've had about 4 series within that team. And I want to mention that at the first is the ESV Salam Oyewumi, a fellow of the institution. He took us on a topic called Understanding Purpose and Basis of Valuation for Practical Application in the Assessment of Value. This was done sometimes in March 2022. The second series was handled by our board member, Yasvini Ifadoju. He was looking at the application in property valuation and scope of inspections. That topic was so detailed that it opened a lot of our eyes to what we need to consider when we talk about physical inspections of properties. And that was done sometimes in April this same year, 2022. We also had the third series, which has to do with market comparison method and adjustment of comparability. Ian Keleshuku Honora, who also is a fellow of the institution, handled that for us. That was about 3 months ago, June 2022. Today, we are having one of the most distinguished valuers, and of course, the tutors of valuations, a professor of repute from the University of Lagos. He is going to help us to digest and, of course, expound on the concept of market value and fair value, looking at any comparative analysis for proper assessment of value. I'm sure today's topic is so timely because a lot of us have issues in comparing market value, fair value. Is it a basis of value when we talk about fair value or not? Today, Professor Babawale will help us in doing that. So I want to welcome all panelists. I also want to welcome all our participants, and I want to charge us that we should be, willing to ask the relevant questions so that every one of us will learn. Thank you, Mr. Kamal, ESB Kamal.
Thank you very much for the wonderful background given to the webinar series. Like we all know, today we are having the fourth series, and the resource person is our erudite professor. I'll quickly run through briefly into his profile before we go to the lecture proper. Okay. The profile of Professor Gabriel Kayode Babawale. Professor Gabriel Kayode Babawale holds a bachelor degree in estate management, first class honors from University of Ife, Ile-Ife, now Obafemi Awolowo University, popularly called Oba Awon Universities in Aru Boys. Professor Babawale had Master of Science degree in urban land appraisal from University of Reading, UK, and PhD estate management from University of Lagos. Professor Babawale is the former sub-dean of Faculty of Environmental Sciences and twice head Department of Estate Management, both of University of Lagos. Professor Babawale has taught for more than 25 years at both the undergraduate and postgraduate levels, and has been external examiner also at both levels to a number of Nigerian universities and polytechnics, including the reputable Business School, Netherlands. He has served on various boards and committees of university, including the University Senate and Property Board. His research focus covers property investment performance, risk analysis, valuation accuracy, and property taxation. He has authored more than 60 articles in reputable national and international journals, besides several others read at conferences, seminars, and workshops covering a wide variety of topics in real estate investment analysis and valuation. He is the author of 5 recently published outstanding textbooks on various aspects of real estate investment analysis and valuation. 1, real estate valuation, principles and methods. 2, mortgage financing in Nigeria, principles, practice, and valuation. 3, property taxation in Nigeria, theories, principles, and valuation methods. 4, 1,000 questions and answers on real estate valuation and investment appraisal. And the latest that is just about to hit the market is a handbook on feasibility study of real estate investments. Professor Babawale is certified by the Estate Surveyors and Valuers Registration Board of Nigeria, SVABON, and an associate of the Nigerian Institution of Estate Surveyors and Valuers. He has, at various times, served as member, vice chairman, and chairman of various committees of the Nigerian Institution of Estate Surveyors and Valuers, including education, research and development committees, and editorial board of the Estate Surveyor and Valuer, the official journal of the institution. His decades of professional practice, both in public service and private practice, covers a wide range of real estate consultancy engagements, particularly valuation of different categories of assets for various purposes. Professor Babawale was appointed advisor on valuation to GEMS3, an international consultant to the Presidential Technical Committee on Land Reform, PTCLR. He has also consulted for Unilag Ventures, ExxonMobil, as well as the Pipelines and Products Marketing Company Limited, an arm of the Nigerian National Petroleum Corporation, NNPC, among others. Distinguished colleagues, ladies and gentlemen, kindly join me to welcome Professor G.K. Babawale to the podium. Thank you. Professor Babawale, sir. Okay. Kindly unmute yourself, sir.
Oh, sorry. All right. Thank you so much. Good morning, Mr. Kamardin. Can you hear me? Am I audible?
Yes, sir.
Oh, thank you so much. I'm presently having a little bit of challenge with the laptop. But for now, I will continue to reach you on this, my handset, while somebody is working on that for me so that I can be able to share the screen. Good morning, everybody. Good morning, colleagues. Thank you very much for coming to this particular webinar. Let me start by appreciating and thank the host, Real Academy, and I want to really appreciate you for this initiative. Thank you so much for taking real estate tutorial to this level and for having me on this privileged platform. I want to also join many of our colleagues to appreciate our first vice president, which I understand is the one sponsoring this particular program, for his tireless endeavors to see to the growth and development of the profession, including what he's doing on this particular platform and very many other platforms. I want to say well done. Estate Surveyor and Valuer Victor Adekole Alonge for this initiative and contribution. I want to appreciate and honor every one of our past presidents. I understand with us on this particular program. I understand our past president, Mr. Adetola Shote. You're welcome, sir. Mr. Gershom Enso, you're welcome, sir. Mr. Roland Abota, you're welcome, sir. And Mr. Manuel Wike, You welcome, sir. The Director of Studies, Real Estate Academy, Dr. Samson Agbato. Thank you so much for having me. And of course, Mr. Olalekan Aboderi, Director of Studies. I want to say welcome to everybody. And one more time to all our colleagues that are with us on this webinar. I want to welcome every one of us. And I want to believe that we are going to have a good time together, in this very brief period. The topic before us today is a very crucial one. There's no doubt about that. That is market value and fair value, a comparative analysis for proper assessment of value. Well, in order to save time, because I always have the tendency of wanting to overflow issues, so I will speak largely to the paper, and once in a while I will break to be able to explain one or two things, or as we go on. Now, the topic before us has to do with value, and that's very crucial to us as SS Surveyor and Valuer, where the concept of value is very central to virtually all our professional engagements, all that we do, whether it's in valuation, investment analysis, property management, or agency. They are all underpinned by one value concept or another. Particularly valuation, the object of revaluation is to be able to ascertain a defined value of an interest in property or an asset for a given purpose and at a given time. Therefore, the thorough understanding of the concept of value is very fundamental and of utmost importance to our professional as real estate valuer. And a good understanding of value will help us to choose the right basis of value, the right method, the right set of data, and of course, even the interpretation of our valuation will depend on our understanding of this concept of value. As I used to tell my students, once you understand the principle, the nitty-gritty of value, you can do any valuation anywhere at any time. I've thought of several angles to which we can tackle this task that seems to look like a simple task, but it's a complex one. I've thought about so many angles that I can, use to tackle it, but as I was ruminating on how to go about it, God gave me an allegory. And I want to say that allegory as we just open up to this discussion. The allegory is about the story of a man called Value. Mr. Value is a very influential man, and is a global citizen, very wealthy. His ubiquitous influence is noticed everywhere. Mr. Value's family exhibits certain peculiarities. Unto Mr. Value is born several children, male and female, by several wives. And the wives come from different nationality, tribes, and tongues. Now, each child that in this family bears the name of their father, and each of them also have a striking semblance of their father. However, each of them speak their mother's, his or our mother language or tongue. Another peculiar thing about this family is that the name of each of the children reflects the circumstances surrounding his or her birth, or the destiny he or she is expected to attain in life. Another thing about this family is that Mr. Value has never stopped to have more children. Women come from everywhere to have a child of him. As expected, some of these numerous children are very plain and simple to relate with. Others are not. Also, we have a number of identical twins within this family. Ladies and gentlemen, we are today here to examine the circumstances surrounding the birth and or the destiny of two prominent sons of this family. Their name is market value and fair value. Though market value and fair value belong to different mothers in this family, but there seems to be some similarity in the circumstances of their birth or what they are expected to achieve in life. We are also interested in knowing whether they are living up to their name or their expected role in life. That is the allegory, which I think will open up to the discussion. So essentially today we are looking at the family value. We want to look at that family. And I want to start by looking at the family, the structure of that family, then look at individual, those two particular children of the family, market value and fair value. Now, I want to, before I go on, I want to put something like a summary because I really don't know what much time I have, so that I will be able to at least, let me put a summary of what is the thoughts that run through this discourse, so that by the time I get to the main body, well, I can be stopped when it is time. But let me run through what we are likely to be having, look like the summary or the abstract of this discussion. Number one is to say that fair value is primarily an accounting and audit term. The market value is to real estate valuation profession, just as fair value is to the accounting and auditing profession. What do I mean by that? Anytime an analysis surveyor and valuer talks about value or report about value, unless it is otherwise stated, it is construed to mean market value. And the same thing with accountants and auditor. When they talk about value with respect to business assets, what they have in mind actually is the fair value. So market value is the principal value that real estate valuers seek to establish. Just as I said, and understanding the similarity and the difference between fair value and market value is therefore significant, particularly for estate surveyor and valuer who may be called to prepare valuation for financial reporting, accounting, company merger, acquisition, book value, compensation, and things like that. Conceptually, there's a close similarity between fair value and market value. And the two may be expected to produce the same value estimate for a given asset depending on the circumstances. Make a reference to International Financial Reporting Standard number 13, the Nigerian Valuation Standard, our own green book on its page 72 states that, I quote, "For practical purposes, the concept of fair value is consistent with that of market value, and there should ordinarily be no difference between them in terms of valuation figure reported." This is, however, not often the case. There is often a difference. In fact, the difference between fair value and market value of an asset is what provides motivation for sellers and buyers to participate in the market. That is, the buyer to come in and the seller to come in. In other words, the assessment of fair value is what investors use to uncover hidden investment opportunities. And it's what helps the investor to know whether a particular market value, whether a particular asset is undervalued or overvalued. Now, let me quickly explain that one because it's look like the watershed, in this discussion. Now, I will use the example of a population. I'm going to come to that. I'm going to come to that again and again. Now, in a population, we have, let's assume there's a population in a class or a group of people, and we can have the average of that population in terms of age, in terms of weight, in terms of so many things, the average. Now, the average is an hypothetical individual within that population distribution, while every member retains their individual peculiarity. But the average is a hypothetical individual, and you might be, it's possible that within that population, nobody actually matched that average characteristics. For instance, assuming that in everybody that is tuned to this webinar today, we are looking at our average weight. Assuming our average weight is taken to be 75.14 kilograms. That represents an hypothetical individual within that population. It might be possible that none of maybe 200, 300 joining us today, we have that exact figure as our weight. But that is the figure that represents us. That's the figure that speaks for us. The average is a very powerful, the measure of central tendency is very powerful. So in a sense, as we're going to see later, the market value is that average, hypothetical priced, in an hypothetical transaction involving an hypothetical willing buyer and hypothetical willing seller. Now, the individual in that population can be likened to fair value. Now, the deviation between individual and that mean, is a difference in the estimate, their own personal estimate of the worth of that asset. But the market estimate, because when we are talking about market, you are looking at that hypothetical individual. Now, the only individual among the population that might have or his own weight might coincide with that of the average would be somebody that, as I said, would be a very rare individual, maybe one or two or maybe none. Now, that difference between the mean and the individual, which we call the consumer surplus, is actually what motivates trading. So that's just to emphasize the need for fair market and property market analysis. It is the motivation. That's what either motivates some people to sell and motivates some people to buy. Is what actually brings people to the marketplace to do trading. And now another thing is that fair value is the appropriate and recommended basis of valuation when carrying out valuation for business purposes, as I said the other time. That's financial reporting, merger, acquisition, compensation, and other matter involving court decision and like that. And it is the only, let me not say only, is the principal and the foremost recommended, basis of valuation by the globally accepted and recommended, frontline financial and accounting regulatory body. That is International Financial, that's FRIS, and the generally accepted accounting principles, that's GAAP. Those two bodies, they recommend fair value. I'm just trying to, the importance of this discussion is very important to us. The fair value is frequently used when we're undertaking due diligence in corporate transaction, particularly where particular synergy between the two parties we may result in them arriving at prices that might not coincide with the market value. Now, I mentioned financial reporting. Let me just say one or two things about financial reporting. Now, what's financial reporting? Financial reporting is disclosure of financial position of the health of a company to its management and where it is publicly quoted to the public. Where to the management because, management need to know from time to time the state of their financial performance so that they can be able to address the situation appropriate with necessary policy. Now, to the public, of course, the public need the financial statement to be able to deal with the company in terms of buying or selling. Existing shareholder need it, prospective investor, lenders, government, regulators need it, consumer need it to be able to relate with the company. Now, one thing that now we talk about financial reporting, we talk about maybe merger, those things that we use fair value for. Now, one thing that is very obvious, in the purpose for which fair value is the type of valuation for which fair value is used, which I've mentioned to be financial reporting, acquisition, merger, compensation, and all the rest of it. One thing that is very obvious in those valuations that we are dealing with assets that are already engaged in a particular use. Assets that are already in a particular line of either production or of goods or services. And that really brings something to mind that in our own palace, we see a very close affinity between, even closer than what we have between market value and fair value, between fair value and what we call the use value or value in use. So we are actually talking about assets that are in use. And of course, it also brings to mind the concept which we are all familiar with, or a distinction which we are more familiar with between value in exchange and value in use. Value in exchange now standing for market values, and value in use now stand more or less for the fair value. Okay, now let's now go to the concept of value. I just put that one as a summary so that we can appreciate the importance of what we are discussing today, the role of fair value in valuation, where it comes from, and how it is related to us as assets of fair and value. And of course, to be able to look at, the build up a background, to what we are doing. Now, let's look at value. Now, I want to use an object here. I wish I get something up, but let me use this object that I'm lifting up now. This object I'm lifting up now. Can we all see this object? Now, does this object has a price? Well, of course, we'll say yes. Can we relate to the price? Yes, some of us will be able to relate to the price. Oh, I know this is air week and this how much it sells for. Now, does this object have a cost? Well, maybe some of us may be able to know the cost, of this object. Maybe if we get to the manufacturer, we can know the cost. Now, it has a price which we can observe, if I may use that word, which we can relate with, regardless of where, regardless of my religion, regardless of my personal, circumstances, regardless of my education, regardless of my tribe, regardless of my culture, my religious belief, it has a price. It has a cost. But does it have a value? I'm not talking about, I've been able to quickly bring out the cost and value. I don't want you to think about value now. Don't think about value and don't think about cost. But does it have a value? Okay, you are going to say yes, because that's why I possess it, because it has a value. And that's why maybe I will not allow anybody to just take it away, for that, because it has a value. But what is the value? I'm having that question. What can you say is the value of this particular item or any other item that is just around you there? Can you describe or can you tell us what is the value? I give us just 1 or 2 minutes just to think about what could be the value of that object. I'm not talking about the price. I'm not talking about the cost. I'm talking about its value. Now, I'm sure a number of things will be going on in your mind on, for instance, what will you use to constitute, what really constitute the value, and maybe what create the value. How will you measure the value? How will you describe the value? Okay? How are you going to describe it in terms of is utility? You're going to describe it in terms of how much satisfaction it gives you. Are you going to describe it in terms of, if you can use it, maybe you are using it in a production process, how much it contributes to that production process? Are you going to describe it? Can you get a description that is acceptable to everybody, every time, everywhere, in all culture, in all situation, all religious belief and cultural belief? I'm sure we agree that there's no such one single definition that can give us the, this definition of value, just like where we can have for cost and we can have for price. Now, the summary of what we are trying to say is that the true value, I want to call that the true value. The true value, which is a primary and original intent of real estate valuer, is the summary of it that is unobservable. It is indescribable, and it is unidentifiable, and therefore it is not achievable. And that is why you see the issue of value over the years has constituted a lot of problems. Plato, a Greek philosopher of the classic time, was quoted as saying that the concept of value is the most difficult question in all sciences. And people, political scientists, philosophers, valuers over the years have been laboring to get a definition or description for value. But so many questions still remain unanswered, and today there's no single definition of value. Now, from this peculiar characteristic of value comes 3 attributes that are going to help us today in our analysis. Number 1 is that is the multiple concepts of value. The multiple concept of value. The imprecision of the definition and meaning of value has given birth to multiple concept of value. So that today it is traditional for everybody, not only essence of value and value, but mainly essence of value and value, to qualify value. Because we don't have a single definition that can describe value, a given single value, one all-encompassing definition. So we have to view value from its very many multidimensional and multifaceted perspective. And because of that, every time we use value as a system of value, we qualify it. Just saying that, well, this is the aspect of it we are looking at. Value, the true value looks like a monster, too big, for us to be able to observe or to be able to describe. So we we look at an aspect of it each time. So we qualify value. So we have market value, fair value, mortgage value, probate value, insurable value, probate value, residual value, for sale value, rateable value, and a multiple of value concepts. So the first thing that comes out of that peculiar characteristic of value is that we deal with multiple concepts of value. The same value, like our Mr. Value we talk about the other of many children, the same value, but we can only see an aspect of it at a particular time. So then those qualifying adjectives that we use to qualify value, rateable, mortgage, probate, residual, they suggest the underlying principle or purpose for which that valuation is required. Some of these adjectives, qualifying adjectives, they can be measured objectively, like market value. It can be tested, it can be measured objectively, you know. Others could like fair value, we are talking about there, which has to do with morality, because when you're talking about fairness, you are talking about equity, you're talking about morality. They are not quantifiable, they are not capable of being measured. And that's why when you look at textbook, you see consistent definition of market value, because it is objective, it is measurable, it is testable. But when you look at textbook, you look at 10 textbook for the definition of fair value, you can get almost 10 different definitions of value, because the qualifying adjective is highly subjective. Now the second attribute we are taking out of that peculiar characteristics of value is that because we cannot define value, it's not observable, it's not describable, we have to look for something very close, something else very close, a surrogate to represent value, something else that is observable and describable and identifiable. And of course, the closest next of kin to value has been price. So we define market value, for instance, as the best price, as an amount. But we know that value and price, they are not the same. But that's the best we have that we can use to represent value. Everywhere you see the definition of market value is either an amount or the best price or this thing. So subject to certain general limitations and contingent conditions. Those contingent conditions are there to remind us perpetually that market value is not the same thing as market price. You know, those attached conditions, enough time to negotiate, a willing buyer, willing seller, knowledgeable, and not really, they are reminding us that where we are using price to define value, but price and value are never the same. And of course, what makes them not the same, those conditions, they are difficult conditions to cross. Okay, but at least we know that the value can be described in terms of price. Now, the third one, which we can get out of, is that that value has no life shelf. It has no life shelf in the sense that value is only valid for a time. The date of valuation, or the accountant will call it the day of measurement, because the numerous factors that create, modify, and destroy value, they are always constantly at work, and we can only guarantee, their activity at a particular given time. That's why, we as valuers, we should not allow lenders, mortgagees to put unnecessary responsibility on us to provide them a value that answers for all time. There's no such value anywhere in any market. Value is at that time of valuation, and that's the only thing you can get, because those factors are beyond an outside of control. Now, having said that, Now let us, having seen that family, let's now go to market value. Now what's market value? Now we have already said that market value is defined in terms of market price, because that's the best we have as a representative, something we can observe, something we can define, something we can identify. So, but market value, as I said a short while ago, is the best price obtainable maybe for an asset in an hypothetical transaction involving hypothetical willing buyer and hypothetical willing seller. And what do I mean by hypothetical? And I think I explained it a little bit the other time. And I'm going to go back to that illustration. Assuming that every one of us tuned to this webinar, we are looking for our average weight. And our average weight, as I said the other time, is 75, maybe 1.4. And I said that the person that has that average weight, which is we call it the central of tendency, that's the measure of central tendency, that the mean, which is a very powerful measurement, which is normally used to represent a population, which speak for the population, which represent the population. That mean value is what speaks for this population. In fact, we address that population in terms of the mean value, the mean of that particular group. And that is a function of the property of the market value there. Is hypothetical. We may not belong to, no one individual within that population may have the typical characteristic of that mean value. But as I said, it represents everybody. So when we're talking about market value, we're talking about that type of price. So it presupposes a probability distribution of market price within which the market value represents the expected value, which is the mean of the probability distribution, okay? So, and that's market value for you. It is the expected value in that probability distribution of a range of prices for that given. Let me take an example, a 3-bedroom bungalow flat in Abule Oja, here where I am. Assuming the minimum rent is about 750 and the maximum is about maybe 1 million naira. That's the range. Within that range of price, we have so many other prices. Now we find the average, we have discovered the average is 800,000 naira. So that's 800,000 naira. Anytime we say, okay, what is the going price for Abule Oja? We say it's 800,000 naira. But it's not all the flat that have 800,000 naira at their value. But that is the mean for that probability distribution, and it represents that population, and it's accepted everywhere as the representative figure. So, and that is the market value for it. Now, each individual within that population group, we can liken them to the fair value, which have their own peculiarity. Because we're going to see later that as I drew from when I was looking at financial reporting, the watershed between market value and fair value is that when we are talking about fair value, we are talking about something that is investment and investor specific. Now, the market value talk about a man of average competence, an hypothetical man, that may not coincide with anybody. But in this, when we're talking about fair value, we're really talking about specific asset in a specific engagement, and as we're going to see very shortly, with specific, buyer and specific seller. And maybe I need to say one or two things about the type of probability distribution. Well, the type of probability distribution, every market data, particularly with property, the appropriate probability distribution is a non-skewed bell-shaped normal distribution that has the mean equals to the mode and the media. Because that one is also important for us to take note of that. Right now, okay, so we say that in theory, market price and market value should be the same, but that is seldom the case, and I've just explained it. Unless there's a particular individual within that group that has it, that his own requirement is typical of that average man that, that we have found to be 75.14 kilograms. Every other person will have something that is different from that average, and that represents what I call the fair value. Now, let's go to fair value. We have already explained, we have seen who the market value is and the characteristics of market value. Now, another thing that we know about market value is that market value is the economic principle underlying market value is that of highest and best use, and we know all the other definitions that go with it, enough time to negotiate and all the rest of them, and because market value is market derived and market determined, then we can expect it to move. It's always changing. Market value is not stable. It's not to keep changing with the movement of supply and demand within the market. Now let's look at fair value now. Fair value, as I said, is the recommended basis for business asset valuation. Fair value is used for valuation of assets already engaged in a given line of business, making fair value to be synonymous or interchangeable with some of those bases we are used to value and use. Even investment value is closer to those terms than to the market value. The International Valuation Standard Committee, in its more recent manual, is seeking to replace the term fair value with equitable value, which is defined as, I quote, the estimated price for the transfer of an asset or liability between identified, knowledgeable, and willing parties that reflect the respective interests of those parties. And that, as I said, is the watershed. Whereas market value does not give room for that. All those undue stimulus, all those special interests, no. But fair value is the investment and investor specific. Even though you still have all those willing buyer, willing seller, and all the rest of them type of condition attached to it, just like market value. So when we are doing market fair value valuation, the input includes both market information, just like you do for market value, but also the individual's investor specific goals, demands, and needs. And needs. Fair value focuses on the contribution of the asset to the overall value of the business organization, and with less regard to its alternative use or the value as if it was sold. Okay, assuming we sell this thing, no, you don't look at it that way. It's a value in use. It is the contribution to that organization, that business, that line of production that you look at, not, assuming we want to sell this in the open market. No. So fair value, so that's why I say it has a lot of affinity more with value in use, worth, and investment value than, market value. Fair value is an unbiased estimate of the potential market price, taking into account the objective factors of the cost of replacement, market supply and demand, plus the subjective factors of the risk characteristics of the investment, the risk disposition of the investor, cost of capital, target return, individual passive utility. So valuation input, as we said, include both market information and individual investor specific goals, demands, and needs. So another thing we need to know about fair value is that it is the value of the asset to a particular investor or class of investor, or identify investment objective, or the maximum or the minimum capital sum an individual will be prepared to pay or sell. I'm just quoting from one of the evaluation standards. So unlike market value, fair value is not entirely market derived and market driven. So it is therefore more stable than market value, which fluctuates with the movement of demand and supply. Fair value approximate to market value. We can now say fair value equals to market value plus element or special value. Special value refers to offer, by special purchaser who has something, like somebody has maybe an office, you want to buy an office and you know that office has not been performing well because there is no parking space. And there's a plot of land that is there. And in order to be able to beat other competitors, you may want to pay a price higher than the market price, just for you to be able to do that. So it's special interest coming to it. It's ready to pay a premium over and above the market price to be able to secure that particular plot of land because of the benefits that is going to derive from it. And so the fair value is also we find a lot of fair value examples so in valuation that we call marriage value, synergistic valuation. We have a lot. The transaction, those synergistic investors, what brings them together is the element of fair value, the value over and above the market value that, both the seller and the buyer are likely to get in that synergy of the two property being matched together. So we have seen the characteristics of market value. We have also seen the major characteristics of the fair value. Now let's see whether I can draw a similarity and differences between two of them. We have already mentioned them, but maybe I can put them together now. Now, say market value and fair value are not only the most popular valuation basis used for real estate value and accountant respectively, but they are both similar in meaning, definition, approach, and method of valuation, and applicable limited condition. Let me also mention the issue of valuation method. What is the valuation method we use to arrive at market value? Where we have the market methods of comparative, of income capitalization, and we have of course and cost. And of course, income capitalization, we have an extension of which is the discounted cash flow. And those actually are what is used for fair value. But because fair value it has to do with, as we said, is both investment and investor specific. We discovered that discounted cash flow is more amenable because in discounted cash flow, we can refer the peculiar characteristic of both the individual investor and investment. So, but essentially, those market methods are what we use both for the two metrics, the market value and the fair value. So the two metrics rest on the same economic principles of highest and best use, looking at the similarity and the differences. The method of valuation for both fair value and market value are the same, the traditional method of valuation, just as I've explained. Both intrinsic and extrinsic factor combined when you are estimating market value and fair value. The only thing is that when you are estimating market value, the extrinsic factors are more dominant. They are more prevalent. But when you are estimating fair value, of course, the intrinsic factor, I mean, those factors that are in the object itself, that make up the object itself, that in the object itself, that is within the object itself, they are more prominent when you are estimating, but the two of them combine intrinsic and extrinsic characteristics in various proportions. The only thing is that the market value is skewed towards more the extrinsic factor, while the fair value, do the other side. The intrinsic factor, market value, fair value is market value plus special value. I've already said that one. While market value generally describes the best price to be expected of an interest in property freely exposed to the market over a reasonable period of time and resulting from an exchange between willing and knowledgeable buyer and seller, neither being under any undue stimulus. Fair value acknowledges the possibility of an undue stimulus. Now, unlike market value, fair value is not entirely market driven, so it's more stable. I've already said that one. In an efficient market, okay, I need to emphasize that one. Now, the other time when I was describing the relationship and I was using the mean within the distribution and the individual peculiarity, within the something. Now, the deviation between the mean and individual members of the population, which I call the consumer surplus. Now, in an efficient market, in an active market, which is transparent, where information flow very freely, where you the product is homogeneous, you will discover that when there's a difference between the mean and the individual value, information that is freely will enable market participants to adjust very quickly. And what you discover that in such markets, like the market for equities, like the market for industrial products like oil, like gas, like coal, market for agricultural products like wheat, like cocoa, those markets that are efficient, we can call relatively efficient, you discover that the market value and the fair value will almost be always the same, because the information and because of the nature of the product themselves, when there's that gap, the people adjust, participants adjust, and of course, they will always adjust towards the mean. So you discover that the mean value and the fair value remain almost essentially the same, in that market. But when you're talking about market for like properties, that you don't have repeated sale, we have a frequent sale, we have an heterogeneous product, the information is not freely flow, of course, there will always be that gap between, the market value and, of course, the fair value. And that's why for that market, investors who are very smart, who can analyze market value and mean value, will take advantage of some hidden benefits, when they can see that there's a difference between their own perception, looking at their own situation of the value and the market value. And when the market value is higher than their own, they can sell, and vice versa. So the difference between market value and fair value there now depends on the market. In active market, in efficient market, you see them very close together or the same. But when you're talking about value market like that of real estate, where have those characteristics which I just mentioned, you discover there's always that distinction between, market value and fair value. And as I said, smart investors who know how to analyze market value and fair value will take advantage of those hidden opportunities that are there in the market, for them. Then, okay. All right, so let's look at the conclusion. Fair value is primarily an accounting audit term. Fair value is the appropriate and recommended basis for valuation when carrying out valuation for business assets and for such as financial reporting, merger, acquisition, compensation, and all the rest of it. Whenever real estate valuer talks about valuation, business or valuation of business assets, they are actually, it's mandatory that they use fair value. So that is the recommended basis. And because we are submitting this report to accountants, we must speak the same language with them. And of course, that is recommended basis by the regulatory body. So we must be able to, they can't report certain aspects of the financial report, for instance, in fair value, and we bring our own market value. So we must speak their own language, particularly when it comes to financial reporting. Real fair value has a meaning and definition is synonymous and interchangeable with intrinsic value, use value, worth, and investment value, which they are more familiar terms to us as excess of real value. To determine fair value of an asset, investors, regardless of the investment method they use, they are likely to come up with different estimates due to differences in goals, circumstances, and needs. So fair value can be higher than the market value if buyer places a higher value on the asset than what informed, purchaser, which is represented by our average man in the market, we put on the same asset. Now, what's my recommendation? Recommendation now is this. Given that fair value is both investor and investment specific, real estate value attempting to estimate fair value for business assets require the following additional knowledge and expertise in addition to a thorough understanding of the concept of value. Number one, such individual must have adequate knowledge of the investors or the firm's objective, needs, tax status, their risk disposition, and the investment, their risk profile, and their return potential. In which case, the peculiarity of that investor, we need to know it. We need to be able to know it because we are estimating from a given specific individual or group of individual point of view. And also, we must also have this knowledge about the asset itself. Adequate consideration of the key element of the market transaction involving the specialized assets that we are talking about. We must understand the assets, its function, and its environment. We must have good knowledge of the specification that will be required for an equivalent asset. I mean, assuming this one is no longer in production, assuming it is assuming it has suffered functional solution, and we don't need to replace it with this one. We must be familiar, with those equivalent assets in the current market and the cost of acquiring and procuring them. And finally, we must have adequate knowledge of the assets and its marketplace in order to determine the remaining physical and economic life of the asset. And of course, must have adequate knowledge of the sector in question in order to be able to assess the functional, technical, and economic obsolescence of the asset. We must have good knowledge of that sector which we are dealing with. On that note, I think I will just take a break. I want to thank you for the audience. I'm sure that the panelists will be able to fill in the gap and question and answer. Thank you so much for the audience. Over to you, Mr. Kamarudin.
Thank you very much, our professor. In fact, I don't know how to really appreciate you. This is a very wonderful presentation. We are not surprised because when you put round peg in round hole, that is the result you get. Thank you very much for the time and for the wonderful presentation. Now, we want to go to question and answer session. Question and answer session. I have some question here. Let me see. Thanks so much for this new one analysis in my life on value. Okay, thank you, sir. More insights on fair value and foresee value. Okay, I think Mr. Yakubu Yewa has, I think he wants a clarification or the differences between fair value and foresee value. Then Mr. Thomas Ashaolu, Estate Surveyor Value, Thomas Ashaolu said, Professor, sir, I really enjoyed your breakdown of these concepts, but sir, can practitioners be advised to rather pursue a further qualified but yet accounting concept closer to our traditional market value? Fair market value includes, which somewhat de-emphasize the less quantitative moral/equity issues in favor of market focus. Okay, I think those are the two we have now. So we can type our questions in the question and answer session so that we'll read them. So, Prof, sir, maybe you can attend to those ones before, while we are waiting for others to send in their questions. Thank you, sir.
Okay, thank you very much, Mr. Kamaluddin. I couldn't get the detail of Mr. Salu's question. Maybe you need to come up with it again, but let me quickly see whether I can hear the question on first save value and fair value. First save value is a proportion of market value. Let me look at it from, first of all, first save value and market value. When you want to do valuation of market value, I mean first save value, of course you first arrive at what is the market value. And depending on the risk characteristics, security characteristics of the property, including the state of the market, you can advise on what proportion of this market value can be said to be the first save value for that property. There's no particular standard for that. That has to do with so many factors: the type of property or asset, of the market, and so many things we discuss. Because what you are trying to do is to provide a measure of security for the mortgagee, and that measure of security depends on so many things, and so the first save value as a proportion of the market value, have to be determined based on those factors. So, but if you cannot relate first save value to market value, then we cannot relate it to fair value. So when we are talking about, we have already stated the circumstances in which fair value become the appropriate valuation method or basis, and when that particular purpose is invariably or for mortgage purpose, of course, then a proportion of that will have to be taken depending on those factors that we have already enumerated. All right? Can I have the question from Salu again? And can I have it?
All right, sir. Thank you very much, sir. He said, Prof, sir, I really enjoyed your breakdown of these concepts. But, sir, can practitioners be advised to rather pursue a further qualified but yet accounting concepts closer to our traditional market value? Then fair market value, in quotes, which somewhat de-emphasize the less quantitative moral/equity issues in favor of market focus.
I still couldn't get. I'm trying to see whether I can locate the question myself. I see, because it's breaking. Your communication is breaking. I couldn't receive the whole thing. It's breaking.
Okay. I think you can access it in the question and answer session.
Yes, that's what I'm trying to do. Yes. Okay.
About the third, I think we have TA as the acronym.
Okay, Prof, I really enjoy your, but sir, can practitioners be advised to rather pursue a rather qualified but yet accounting concept closer to our traditional market value, fair value, market value, which somewhat de-emphasize the less quantitative moral equity used in favor of market focus? Well, okay, thank you, Mr. Shalu. Well, my own counsel is that, it's been advised we have been advised that every time we are doing valuation, the valuation should be consistent in terms of the basis and methods. Well, if I really understand the question you are trying to ask, I believe that the purpose of the evaluation actually will dictate what method and what is to use. Whether we are to use, there's no particular base that can say is for the every time and every purpose and for everybody. So it all depends on the purpose of evaluation. What exactly is the client trying to get at? You know, so we put ourselves in the position of the client anytime we are doing evaluation. What exactly? The question is, what exactly does the client need? For what does he need it? You know, and from that we determine basis of evaluation and what is the method of evaluation and what is the assets, and the data set that is required. I really don't know whether that really answered the question. Hello, Mr. Kamadri.
All right, thank you very much, Prof. We also have some questions that have just come in. Mr. Waneka Osewa said, thanks, Prof. Sometimes we see something like fair market value. The question is there a difference between fair value and fair market value?
Oh, yeah. Are you talking to? Sorry, I'm sorry. Yeah.
Oh, you didn't get that, sir. Okay, let me, the person wants to know whether that sometimes we hear something like fair market value. So it's trying to know if there's difference between fair value and fair market value, whether they are the same or there's difference between them. Hello, sir.
Mr. Kamadri, I'm very sorry. I can't hear anything that is coming from you. I see you speaking, but I can't. The voice is not coming up here.
Hello, sir. If you can hear me, can you hear me now, sir? Hello? Hello?
Hello, Mr. Kamadri, I can't hear you.
Okay, can you hear me now, sir?
Prof, I think you need to unmute yourself, sir. Prof, you are muted. Prof, can you unmute yourself, please?
Okay. Hello. Why we wait for Prof to come back? Let's use this opportunity to recognize two of our panelists. We have in the house the person I can refer to as the chief regulator, Estate Surveyor and Valuer, the chairman of Estate Surveyors and Valuers Association Board of Nigeria. I think at this point I have to mind the language I use so that my seal will not be withdrawn. My seal is very important to me. Welcome, sir. Then we also have in our 23rd president of Nigerian Institution of Estate Surveyors and Valuers, Estate Surveyor and Valuer Land Abonta. Welcome, sir.
Thank you very much. Thank you.
Let's come back to Prof now. Prof, can you hear me?
Yes, breaking by better.
Okay. Yes, if you can hear me now, can I go on with the questions?
Yes, please.
Okay, thank you, sir. Okay, the next question is about fair market value and fair value. This person said he has been hearing of fair market value. Is there any difference between fair market value and fair value?
Between what?
Okay. Hello, sir.
Yes.
Okay,
yes.
I can hear you now, sir.
Can you come?
Wow. I'll call you back. What is now?
Okay. It's not audio.
Hello. Okay, I think it's the network from Prof's end is. It's not. Yeah, the network is completely. Okay, while we are waiting for the network to get better, my teacher just informed Okay. Yes. But my attention has just been called to the fact that we have in the house, in the panel room now, the sponsor of this webinar series. The sponsor of the webinar series is our own estate surveyor and valuer, Victor Adekunle Alunge, the first Vice President of Nigerian Institution of Estate Surveyors and Valuers. Welcome, sir, Mr. President. Prof, can you hear me now?
Yes, I think it's better now.
Okay. So the question is about fair market value and fair value. Somebody said he has been hearing of fair market value. Is there any difference between fair market value and fair value?
For all I know, there's no difference.
Thank you, sir. Then another person, Mr. Abdul Emmanuel, said, is first sale value still important in concluding valuation exercise in the current dispensation?
Well, to me, my own advice is that we should not allow lenders and mortgagees to put unnecessary burden and responsibility on us. Because the difference between market value and first sale value should be the responsibility of the mortgagee. They are the one that know what risk that they face. We are not risk officer. They have their risk officer. Me, I normally want to advise valuer, give them the market value, let them use their own discretion to know what proportion of that is the property is worth, based on their own risk analysis and their risk disposition. So that is my own. I think, and that's very personal, because there is a way that the lender want to shift the blame on valuers. Deliberately shift the blame on value. Yeah, we can estimate market value, but there's no standard for first sale value. The proportion depends on so many factors, and they normally have their risk officer. Their risk officer should take care of that and advise them and derive their own first sale value based on the analysis of risk. both as pertain both to the property and to the mortgagor. Thank you. Mr. Lawa, can you hear me? Hello, Mr. Lawa.
All right, thank you very much, Prof. The next question is from Mr. Abdurrahman Adedotun Uju. It is really a pleasure to be here. I have a question, and the question is giving your definition of fair value as being used for valuation of assets already engaged in a given line of business. Can we say fair value is synonymous to going concern value? Hello, Prof.
Well, fair value is a basis. Going concern value is a purpose. So the two of them, they are not the same thing. The fair value is a basis of arriving. You describe the type of value you are looking for, whereas the going concern is talking about the purpose of your valuation. So I don't see the relationship that the questionnaire is trying to draw in that question. Different.
Okay. All right. Thank you very much, sir. Then we also have another one from Ezekiah Adebayo. Thank you so much, Prof, for the lecture. Whether market value or fair value, the problem is data to get accurate valuation. He says lettings data are difficult to come by in Nigeria. How do you carry out valuation without reliable data or data bank? ESB Bayo Alabi. Okay, I think the question of data is a general one, and it's something that I don't know if Prof has anything to say about that. If not, let's go to the next question.
Well, he has already said it because the valuation is it's data driven. Say garbage in, garbage out. There's no magic about valuation. We are not creator of values. We are experts in the market, and we are to interpret the market. And what do you use to interpret the market is the data. So when you don't have the right data set, then of course your interpretation will be wrong. Now, if you want to go to a place now, you want to talk about the people there, but the information you get is the wrong thing, then you go away and with a wrong conclusion. It's just as simple as that. So I quite agree with him that the issue of data is paramount, but that does not to say that the basis of valuation is not important. They all put together to make a reliable valuation.
Okay, thank you very much.
The basis must understand the basic Sharia.
Yes. Okay, we have another one from Mr. Mr. Alimi. Okay, I think this question is okay. He said, "Sir, are the basis for market value and fair value the same?" I think the lecture has answered this. Both market value and fair value are basis of valuation. Okay, then we have a question from Abel Uluoli and Jory. Prof, sir, is it recommended to include fair market value in valuation reports for mortgage purpose?
For what? For what purpose?
For mortgage purpose. including fair market value in valuation report for mortgage purpose?
Well, just as we have said again and again that fair value is primarily an accounting concept and is meant mainly for accounting purpose. We are job, but because we have that relationship, particularly when it comes to financial reporting and business asset valuation, that's why I believe that we are concerned with this particular is the accountant that originally coined that name. And so if the business asset is being assessed, is being valued for mortgage purpose, for instance, I don't see how fair value can come into. Don't forget that fair value actually is how an individual is investment specific and also investor specific, you know. And I think the purpose should just be reserved for what it meant. It's meant for things like merger, it's meant for acquisitions, meant for compensation and all the rest of them. I don't think it's the right basis. It won't be the right basis. The market value will be more right basis for when it comes to mortgage than fair value, because the fair value does not represent the market, you know. So it's the market value that represents the market at any given point in time. So the fair value can be over or above the market value. And what we are going at when we are talking about mortgage valuation is the market value. So fair value will not be a basis for that.
Thank you very much, Prof. Then we have another one from estate surveyor and valuer Toyin Agbalaya. As estate surveyors and valuers in public service, we use fair value in our assessments. We consider that our valuation is for taxation purposes, so our value is usually lower than market value. Are we doing the right thing, sir, considering your explanation today?
Well, in taxation, fairness is promoted above accuracy as far as valuation is concerned. When it comes to taxation, we play down more on accuracy. We emphasize fairness because of the purpose for which property taxation is meant. So I don't think the goal in property taxation should be accuracy. It should be fairness. And if you're going to achieve fairness, of course, there will be a little bit of compromise here and there for accuracy, which means most times you discover you use a value quite lower than the market value. So which is right. So I think it's right. Because the target, the primary goal, the primary purpose, the primary thing that the valuers seek to achieve for a tax valuation that will be sustainable, that will be fair, because fairness has been a very big problem when it comes to property tax or tax generally. And we hold it because it is the valuation that is actually the root cause of whether it is fair or not. So I quite agree with you that when we are doing valuation for rating purposes, we must play down on accuracy and emphasize fairness.
Hello, sir.
Yes.
Okay, I think the last part.
Can you hear me?
Yes, we didn't get the last part of your response.
Yeah. Now, what I'm saying is that it's the same. I'm just trying to emphasize the same thing I've said, that when it comes to property taxation, fairness should take precedence over accuracy. And so we expect that valuation for taxation should be lower than market value generally, you know. And what we should emphasize more is to look at the method that distributes the burden of taxation between property more fairly than more accurately. Can you hear me?
Yes, sir. Thank you so much, sir. Okay, we have another one here by Ismail Olaniyi Olojede. Thanks so much, Prof, for your time and the knowledge sharing. My question is, to what extent does the fair value valuation insulate the valuer from the big stick of the financial reporting legislation? Because my understanding of your submission on fair value is the effective demand of the investor at a point in time without recourse to its source of equity. Thank you, sir.
I didn't know whether I really get, and I wish I could get it. Please, can you just come over again?
Okay, I think what is trying to, yes, what is trying to know is that to what extent is the fair value valuation insulates the valuer from the big stick of the financial reporting legislation. That is, to what extent does the fair value valuation insulate the valuer from the big stick of the financial reporting legislation?
I don't know what type of insulation my colleague wants, from what? There is always, that's why we have a professional standard manual, because valuation is a non-exact science. And that's why value has to be guided by rules and regulation so that we can stay within limits. We know the valuation cannot be exact. There's no exact valuation. You can't say there's no absolute evaluation, but then it must be within a permissible range. Okay, and that's why we have manuals that guide us so that we can exercise our freedom within reasonable limits. And so we want to do valuation for assets, which is particularly meant for financial, to be familiar with valuation by the regulatory body, International Financial Reporting Standards, the General Acceptable Accounting Principle of Practice. So we need to get used to it. Manuals are very important. Our green book are very important because these are the things that help us and guide us. And we must prepare evaluation with the hope that it can be a subject of litigation. And one of the things that are going to help us out is that we have been able to confirm with the approved standard. Because the approved standard may not be a law, but the judge and the court normally have regard to it. It's just like a doctor. A doctor, provided he has done it according to ethics, even if the patient dies, he cannot be held responsible. We have had similar court cases that the only thing that saved the valuer is that he has complied with the approved regulation. So we must ensure that we apply with the approved regulation. It's going to defend us in time of trouble. If we get in trouble, regulation is an indemnity. So that's the only thing I think my colleague is trying to talk about.
Thank you very much, Prof, for your time and the presentation. It has been a wonderful one. That's how much we can take about on the question and answer. I think we've exhausted almost everything here, except for the ones that I feel that have been answered by Prof in other people's trying to answer other people's question. Okay, I can also see here that people are asking for the materials, and I can assure you that we are going to get the material across to you through the email with which you register for this webinar. Now, I want to go to the panelists, contribution or comments by the panelists. And here I want to start from the chief regulator. I said earlier that I have to mind my language here today so that my seat will not be withdrawn. I still like this profession. So I have to start. So please permit me to start with the estate surveyor and valuer Gershom Henshaw. And to even make us know, I think estate surveyor and valuer Gershom Henshaw, in few weeks or this time, or is it few days, he will be a holder of a national award. As we speak, is a national award designates. I think MFR. So this is a recognition to our profession. We appreciate the federal government for that. So comments, contributions, sir? Yeah, Estate Surveyor and Valuation ensured. Thank you, sir.
Thank you so much, my noble colleague. I hope you are hearing me.
Yes, we can hear you, sir.
All right. First of all, I want to thank you for this effort, because this is what we are praying, that our members should devote their time and energy towards advocacy and bringing our members to a global best practice in terms of knowledge and way of doing things. I thank my prof who has taken time to try to break to our understanding the fair value concept and the fair market value concept. What I want to say is that this is the beginning of a series of more discussions we're going to have, because Prof has agitated our minds by, for me, two things. He has talked about fairness when it comes to value for taxation, and accuracy when it comes to market-driven valuation, which is that's another big stake for us to take. Maybe next time we will be talking about fairness and how we will be able to think we are fair, because fairness should be to all concerned, not just our clients or the government, but we should walk a tightrope when we arrive at the value for taxation and or for market-driven purposes. Be that as it may, I want to say that other members should please drive more. We have a lot to talk about when it comes to our profession, because it is still virgin. There are so many areas we have not gone into. And I would like us to look more into the aspect Prof mentioned, that is more of accounting process, so that we do not want to say that we do not know what they are doing, but we want to take responsibility. Please note my word. We want to take responsibility for whatever we do and ascribe as to value for any purpose which we are engaged to determine for any of our clients. On that note, I will thank you for this opportunity. And well, I use this opportunity, since you already know about my National Honors Award, I take this opportunity to invite all my colleagues and thank them for wishing me well. And I pray I should be able to deliver on this mandate in furtherance of our profession. Thank you so much.
Thank you very much, sir. It's an honor well deserved, and it is a recognition, like I said earlier, it's a recognition to our profession. It shows that people know that people called estate surveyors and valuers, or a profession called estate surveying and valuation exists somewhere. And we pray that this will be the beginning of many good ones to come the way of estate surveyors and valuers in general. Thank you so much.
Thank you, sir.
We also have in the house, we have the 23rd president of Nigerian Institution of Estate Surveyors and Valuers, the person of Estate Surveyor and Valuer, Roland Abonta. You have the floor, sir.
Thank you, beloved noble colleagues. Thank you for the opportunity of registering me to participate in this well thought out professional section. I joined my chairman of SVABON, ESV, Sir Gershom Henshaw, MFR. We are not waiting for the day. The letter has already appointed him, and so he is. So anytime his name is pronounced, we need to mention that. Maybe the only one in our great profession. So we thank God for the sources. My chairman, I salute you, sir.
You're welcome.
Well, Thank you, sir. Well, I would like to say that this is a great program that have taken up the area we can call our own core competent area in professionalism. That is valuation, as it were, in general. And like the chairman mentioned, we should devote more of our energies trying to, train up ourselves, acquire new skills in the profession God have given us, and focus on how to develop the profession than most of other things that have distracted us so far. I, for one, I am really concerned about our retaining our hold on valuation before we have people take it out of our hand. Today, we hear so much about business valuation and all other kinds of valuations that are being coined out. And they all belong to the estate surveying and valuation profession in Nigeria. That's the profession that is in charge of whatever is called valuation, whatever will ascribe value to any assets in the country is within our competence and purview. And we have only one valuation registration board in Nigeria, which is also the board of our own profession. So I appreciate the organizers of this program and thank them for the opportunity given us to come and listen again. I joined late. I didn't hear more of the Prof's lecture, but I believe that when the copies are sent, we will all get it and digest it properly. The future is very bright for this profession, I must say, but we must make sure that we secure that future by preparing ourselves for the various challenges and new developments that are coming up in the profession. So for now, I would like to say that I'm happy to have participated, particularly in the area of discussion of the question and answers we have listened to concerning fairness and valuation, concerning the differences in market value and the fair value, fair market value. All those things are, like the Prof said, some of them are the coinage of the accountants and other people who have to work with value. But the truth is that you may not find substantial difference when you are looking at market value and the fair market value. I also agree with Prof that the issue of risk assessment should be left for risk officers and not valuers. The method of conventional to third of value as for sale value cannot be defended empirically or scientifically. You cannot defend that. Whatever weight you give to risk that will make you deduct only 1/3 of the value and call the rest for sale value may not be defendable in a law court or any other place where that thing is questioned. So there are issues vary from situation to situation. That's why I tend to agree with Prof that risk officers should be the ones assessing to determine that. Once we give a value that is market value, it will be sufficient for the accountants, for the risk officers to determine what they would have as reserve price, which is what they are looking for in the area of for sale value. I want to stop here and say thank you for giving me opportunity to participate by registering me in the first place and also admitting me to the meeting. Thank you and God bless you.
Yeah, thank you very much, our 23rd president. Thank you for the honor and your advice in our areas of practice, in the practice of valuation. Now, the next the next person we are going to go to have, to have a word from our sponsor. But before that, we still have two members of the panelists, two members of the panel who we want to hear a word or two from before we go to hear from our sponsor. And we at this point call on Estate Surveyor and Valuer Samson Agbato for his comments or contribution. Thank you.
Thank you so very much, Yeji Kamal Lawal, our board chairman, our 23rd president, and the first vice president, noble colleagues. I think much has been said by the Prof. He has opened our eyes to see a lot of differences between the two, and of course, where we have similarities. The only thing I can say is to thank the Prof for the time he has given to share his thoughts with us on this platform. I want to thank all the participants too, and also to reassure our members that we need to be firm when we are trying to do valuation for financial reporting and using a fair value as the basis of our assessments so that we can be critical in our thoughts and of course in our exposition. That's what I need to say now because much has been said, so I don't want to belabor those issues that have been raised. Thank you so much, Yeji Kamaruddin. Thank you.
Thank you so much. Before going to our sponsor, let me call on the last person on the panel who has not spoken on the panel. Okay. Estate Surveyor and Valuer, our Director of Studies, Estate Surveyor and Valuer Olalekan Aboderi, to have his comments and contributions. Thank you, sir.
Okay, thanks so much. Let me stand on existing protocol in recognizing all the dignitaries behind the profession that have taken time to be part of this webinar. I want to sincerely appreciate the Prof. Yes, we didn't expect anything less. He had actually justified this topic. Prof actually created a lot of issues that requires further research, further deliberations. Now, drop out from what I've taken from Prof's presentation is that, number one, it is important for members to understand all these conceptual issues and how to operationalize the letters of our standards, the letters of our valuation standard, including Green Book, the letters of International Financial Reporting Standard. I believe if we understand the letters and we try to interpret what the letter will mean or imply quantitatively in assessment of value, definitely we'll always be able to profile the right value on the right basis for the right purpose, and we'll be seen to have worked within what the valuation standard or the practice standard is expected of us. Now, I enjoyed his story, the story of Value Family, and I want to throw it open that the academy will appreciate from the early people that joined, the people that joined earlier, if we can have an interpretation of this value family, the way it is relating to the concept of value as far as our valuation processes are concerned. And we have reward for that. For anybody, the first person to give us most appropriate interpretation of that value, the story of value family in all ramifications, because that story actually goes to the extent of addressing everything, so to say, including the fact that even valuation purpose is not yet exhausted. It can, continue to emerge and emerge. Don't let me let the cat out of the bag. This is a task for us. If you want to win our prize, do your simple analysis of the interpretation and send it to Risk Academy. Then if we find, we'll be very open about it and go through all this and all the reports and then declare winner and announce our prize and deliver our prize to the winner. It was really very, very thought-provoking. It addressed the fact that, no, our resource person today is truly a professor. Because it's not a question of reading from the books or telling us what I can derive from it is that the thing flows readily in his veins. He's able to tell us what are the implications of what we read in books. So we appreciate that so much. Then, again, he had been able to draw distinctly the difference. Noble colleagues, let's take proper assumptions that there is no difference. There are cases where there will be difference. And I want to give an example. If we follow the standard, actually, the standard requires that the use of the property to be valued should be identified. Now, let's consider a case of a property, an office building, partly of which is being used as corporate real estate. That is, the company occupies it and is only contributing to their operations. And the remaining part, let's say 50% as corporate real estate, the other 50% as investment property, in which case that means it's for income generation. If we are to value such an asset under fair value, one thing that is sure is that while we open it to market indices, market implications here and there, the impact of FOID, okay, let me go further to say, consider in your market, we are similar properties in the market experience FOID of say 10%. Where such an asset is not totally and completely introduced to markets, it will not be subject to the full force of market. The 50% occupy that FOID of 10%. Whereas the other 50% will suffer that FOID. Now, assuming the old building were to be introduced into the market as an investment property, the entire building will suffer that 10%. Now, if that property is to be valued from the perspective of market value, which is completely market driven, then the implication of that 10% will be on the entire performance of the property. Whereas for fair value now, because it's a value in use, we are looking at the value of that asset to the company. Now the company has committed a part to its own use. That part can never suffer FOID. Hence, it will be logical to assume that the entire property will suffer 10% FOID. With this, we can see a departure, or a difference between what our fair value will be and what our market value will be for the same property. And we can see the coloration of, as Prof said, of the fair value being so much close to investment value, being so much close to worth, being so much close to value in use. Again, to operationalize that, Prof mentioned about target rates. The moment you apply target rates of return in analyzing your discounting, you are looking at what? You are looking at the investment value of the asset to a particular investor. These are areas where understanding our standards, including international valuation reporting standard in this case, will show to us and we'll be able to defend our opinion of value. And with this, okay, for example, take a situation where the property is totally exposed to the market. It will suffer that 10% all through. It then means that there will be closeness. Fair value in that situation, and market value will likely be the same, unless other conditions are, brought in. So I just try to bring this out as a way to bring down what the richness in what Prof has said, and it's not just theory. There are things to apply in practical sense. national auditors now want you to justify how you have arrived at your opinion value. So, noble colleagues, I want to advise that we try as much as possible. Let's study our standards. Let's study all other relevant applicable standards depending on what we want to achieve. Don't forget, I always say that valuation is like a research. You have a set goal to achieve, then you will know what data to justify the objective and what method to apply to analyze your data so that you can achieve the goal of your objective. If we have a departure from that, we are only doing mental exercise. For us to ensure valuation practice international best practice, we must follow all these principles. And when we do that, we'll be seen to have done our best. We'll be seen to have justified it. Prof actually established the fact that there is no value. It's not observable. There are a lot of issues to that. Now, before I round up, I want to put this to our regulatory body. I'm happy we have the chief regulator with us. That's one. With this lecture today, we can say that our real estate education, the academia, has a lot to offer to us for those of us that are in practice. So let's engage them more. In fact, let's ensure that they contribute to solving real life practical issues. They know where the solutions are. They know the principles. Now let's have process to ensure that we will be able to generate processes or basis of applying all these principles towards solving real life valuation. And we have been thinking of, okay, we have regulatory body, can we be having letter to valuers? Because funny enough, when this topic came out, there were a lot of concerns in most platforms. People saying they are the same, there is nothing. Why do we want to just, be so comfortable, stay in our comfort zone without searching for knowledge? Valuers are supposed to be readers. Because in fact, valuation alone, you have so many purposes, not to talk of all other areas of professional services. We should not just rely on the rudimentary that you have gotten from school and you say you are comfortable. Even that rudimentary, of us don't have good hold of them. And that's why most of us will say what you learn in the school is just theory, they are not practical. I hate that with passion. And I'm happy that the Education Summit, in human anatomy, you don't need any special principles or process to initiate, to analyze whether you are a black man or you are a white man. That's quoting my chairman of ESPABO. So why is it the case in our own profession? Let us look into this so that we will be able to ensure that we do this valuation in the best practice, follow international best practice. And to round up, let's recall that what led to international valuation reporting standard is that valuer will be speaking the same language. Best, like quoting, is it Professor Omo now? Birds in Nigeria will sing the same song as birds in Canada. So we see if our report on the same principle is taken to Canada for analysis, they understand what we mean. Just as if their own is sent to us, we understand what they mean. So we cannot be practicing valuation with our intuitions. Then there cannot be valuation accuracy, there won't be valuation reliability. Let us, in as much as it's not a true science, there are principles, there are standards, even valuation to follow. On this note, I want to thank my professor for this wonder to continue imparting on us, as we always call on him to do. And I want to believe that for the naives, principal officers that are here today, with this respect, and my ex-Fabon chairman, they have been a very good take-home, and I observed my chairman saying that anyway. That we will have to go back and see how can we start applying this. What steps we take, and we take it now. Thank you so much.
All right, thank you very much for wonderful contribution. I want to go, our time is fast spent. I want to quickly go to our sponsor, but before I hear from him, let me use one of his quotation to bring him in. And the quotation is, estate surveyors and valuers are noble people. We are noble colleagues. Being noble means that we there's element of nobility in us. And when we have element of nobility in us, it means we can dine and wine with kings. And I think this is one of the things that has been motivating him to give capacity to allow members to have capacity building, so that when we know we have the knowledge of our profession, we will be true to the nobility, and we will be able to dine and wine with kings. Yes, Estate Surveyor and Valuer Adekunle Alonge, please, you have the floor. Thank you, sir.
Thank you very much, Mr. Moderator. Let me recognize and once again congratulate the chairman of our ESVABON, a man of history, a man of destiny, who we are planning to celebrate on the 1st of October for his untiring support for this profession and your service to this profession.
Thank you.
I also recognize the past president, Ronald Abonta. I don't know if the president, sorry, I'm sure the president is not here, so he will have been the first person, being the leader of the profession. Distinguished council members here, the guest speaker, Professor Babawale, the director of studies, my brother, yes, Babawale, and all the participants of this program. Let me once again welcome and thank you for taking out time to be part of this wonderful program. I'm extremely delighted to be part of this program. And to be honest with you, sponsoring the program has never been a difficult decision for me, because this is one of the areas that we as leaders of the profession can actually reach out to our membership to support in the acquisition of knowledge and building capacity. I patiently listened to Professor Babawale's delivery, and I think I must commend you, sir, for doing an extremely good job. Fair value and market value. I think I'm even impressed that you are able to bring up the recent IVSC position on fair value, trying to update it. This is remarkable, and I'm sure those of us who are part of this program will have benefited from your rich knowledge and expertise. So I thank you so much. I don't intend to actually make comments about the content of this delivery, because I was part of it, and I wholeheartedly align myself with, the theme and most of your delivery. But I think the conceptual, this is a very simple transition. The conceptual framework of these various topics and the practical, the implementation. I think there is what we call Chinese wall there. So there is no difference, because there are some areas that you would see that the concept is completely different from the practice. But in this case, I think there is a meeting a meeting point. So it's not going to be difficult for practitioners to actually comply or implement the conceptual framework and delivery. So it's very simple, it's very straightforward, and I thank you for making it even simpler. I want to commend Rios Academy, and in particular the proprietor, the director of studies. This is one area of service that is not as attractive financially, but I think it's driven by passion. And your passion to actually help your colleagues to make them better, I think is actually recognized. And I thank you. And that's why I said, and I've told you severally that I will always be available to support this program. And I'm stating that again here. And I also want to encourage my chairman of the board, who I'm looking up to be like him when I grow up, to also key into this and, as one of his own programs too. And I know he can do it and he will do it. So I look forward to a time when Rios Academy will have its program sponsored by corporate organizations. And I think it is possible, and we will do it by the grace of God, because we are benefiting tremendously from your service. And as you do this for members, God himself will continue to renew your knowledge, and he will provide for you, financially, because this is not a financial exercise. We are not making money from it. But God is going to replenish you and provide for you in other areas. So I want to thank everybody that has been part of this, and also to please remind us, our president is not physically here, but we're all aware that the president has given us his focus in terms of what this administration is going to do. And these are lovely programs. And I want to invite us to please join the president in actually moving this profession forward. Some of the decisions, some of the discussions in various professional groups, meetings, can actually be put together and forwarded to him, so that we can also take some of it and work on it. The president is open-minded, and he wants the best for this profession, and clearly stated his agenda. So please, let us join hands with him. We mean well, and we are solidly ready to work with you, the membership, to take this profession forward. So on this note, I want to thank you, and once again congratulate my chairman of the board. It is not me, and this is just the beginning. I look forward to when you be promoted to CON and even GCON, because it's not just vice president that gets GCON. Your contribution to the country can also make you there. So we thank God for what you have achieved, and we pray that Ezra, under your leadership, will even be promoted, higher by the grace of God. So thank you very much, Rios Academy. I wish you all the best. I look forward to the next edition of this program. God bless you.
Amen. Thank you very much. Here's the Victor Alunge for the wonderful contribution. We also want to appreciate you for sponsoring our programs. You have never for once said no to us. Each time, because of your love for knowledge, each time we approach you, we want to do this, you encourage us and give support to it. And so far, we have been enjoying the relationship, and we pray for more mutually beneficial relationship. Now, I want to use this medium to also call on other noble colleagues who are blessed. So also, we have several programs, we have several training programs. There are different ways that people can come in to give this kind of opportunity to members to better the practice. We have written letters to some of our colleagues. We are still expecting them to tell us in which area they can come in. Our own is to come up with the curriculum, give training areas, come up with curriculums, and every other thing within our power. Sponsoring, once you are ready to sponsor any program, just tell us the area. We are going to design the curriculum and we would make it happen. So we use this medium to call on the other noble colleagues who are blessed to also use this opportunity to sponsor and so that members can have add to their knowledge, and our profession will be the winner for it. So on this note, I want to call on ESV Olalika Bodering to do a closing remark so that we can close the webinar. Thank you very much, sir.
Okay, Comrade, thank you for the opportunity once again. Not to waste our time, I think the remark is simply that, honestly, I'm so happy for today's webinar. I have been so imparted on. It has been so rich, and I believe that a lot of our members have gained quite a lot. Why saying that, I want to advise that we equally now go back to our various offices and look at this knowledge. How do we translate this to practice? Is a knowledge now, you should convert this knowledge to skill by ensuring that you use this knowledge to solve real-life problems and answer valuation questions so that we'll be able to defend our territory. I want to sincerely appreciate our sponsor who has always been there. May God continue to enrich you and uplift you. And we look forward to many others to come on board. Equally, it was very, very encouraging seeing the kind of my regulator. Yeah, I think incidentally, the one as equally it's necessary to register us as an external training provider. That's a good news for us. We believe that we'll be able to do a lot with S1 in the area of building capacity and ensuring that we defend our territory. We thank you, our chairman, S1, for being part of this. My own past president, Sir Roland Obanta of Knowledge, and about that, I think my internet went off. So I want to say a big thank you to our professor who have made today a very rewarding one to each and every one of us. And I pray that God will continue to show us his mercies in all our endeavors, both in the academia and in practice. Thank you so much for your time. Thank you so much for your confidence in us. And thank you so much for part of this.
Thank you very much, Olalika Bodering. While we close, I want to add my voice to his to appreciate everybody, starting from our chief regulator in the house, who, especially for the fact that Risk Academy has been registered as external training consultants. So with that is what offered us the opportunity to be able to secure credit points for this webinar. This is the fourth series. Each of the series, we are giving 2 credit points, and we appreciate you for this, and we look forward to future mutually beneficial relationship. We always come to you. Like I said, we will always try to come up with things that will be beneficial to us and members of our profession. Then at the regulatory level, we know you always support us as usual. Thank you very much. Thank you, the guest lecturer. Thank you, the sponsor. Thank you, all members of the panelists. Thank you, all noble colleagues, for your time to attend this webinar. We are, like I said earlier, we are going to circulate the materials through the email with which you registered. We'll send the video link and the PowerPoint presentation for further study. Thank you very much and enjoy the rest of your day. Thank you. Bye. Yeah.
All great battles are won when you attack. And so you must. The entire direction of your life. You determine what work you will do. You determine what courses you will study. You determine what products you will offer. You determine your priorities. And your choices determine everything that happens to you. So successful people are those who make good choices. And unsuccessful people are people who make bad choices. And the most important choice is the choice of what you're going to work on. You see, if you have 10 tasks to do in the course of a day, 2 will be very important, and 8 will be unimportant, and 2 or 3 of them will be completely without value. But the little tasks, the one without value, are fun, and they're easy. And so people like to do what's fun and easy, like children. And adults are just children with better excuses. So most adults spend 50% or more of their time doing little things, talking to their friends, checking the internet, making phone calls, reading the newspaper. They spend 50% of every working day doing things that are little and unimportant and that have no consequences. And then they can't understand why they're not more successful. Top people are always thinking slowly before they start and focusing with great clarity on their top priorities. And it's not that you don't do the little things or the fun things, but you don't do them first. You choose not to do them. We say that success requires willpower and willpower. Please don't turn that up. Turn it down. Please don't play with it. Turn it down. There you go. It's okay. It's the same all over the world. There's always 3 problems you have in speaking. They're sound, light, and air conditioning. And they go in that order, like this. Boom, boom, boom. First the sound, then the light. And next thing is air conditioning. They say, well, air conditioning is so expensive, these people won't notice if we turn it off. Amazing. All right. So set priorities and work on key tasks. Choose to work on tasks that have big potential consequences. That's the job of a leader. It is to make sure that each person that reports to the leader is working on important tasks that have big potential consequences. Remember, you will always have far more to do than you have time. So the only way you can accomplish anything is by doing only the most important things. We say, A, always work from a list. One of the greatest time management tools is to take out a list of everything you need and make a list every day before you start. I have written books and articles on time management, and I have looked at the studies. They say that 49 out of 50 top executives worldwide use a list to plan their day. And they write everything down before they begin, and then they set priorities on their list before they begin, and then they start work on their top priority. And if something new comes up, they write it down on the list. They don't just run off and do it like a dog chasing a rabbit. What they do is they write it down. And once you write it down, you have control. And your list becomes your control, your master control for your day. And people who work from lists accomplish 25 to 50% more than people who just work reacting all day long. And this has been tested, and I've worked with tens of thousands of people, and they say a list is like a miracle. If you've never used a list to plan your day, it's like a miracle. Then you go over your list and you apply the 80-20 rule to your list. You say, what are the top 20% of things on my list that are more important than anything else? And here's a great question for you. This question, by the way, will double your productivity, eventually double your income, and make you one of the top people in your field if you can ask this question and answer it correctly every time. And the question is simply this. Looking at your list, Imagine that you're going to be called out of town for a month. And you could only do one thing on this list before you were called out of town for a month. What one job or task or project would you want to finish more than anything else before you were called out of town for a month? Now this is an exercise, but it will always jump out at you, and put a circle around that. That's the one. That's